Hi, everyone, and welcome to the Amber Data Derivatives podcast. I'm here with Neo, who used to run the OTC desk at GSR, currently pursuing a PhD and is very active in the crypto vol markets, also hosts a Telegram channel where he shares a lot of his market commentary. Neo, how are you?
I'm good. Hi. Thanks for inviting me.
Yeah, absolutely. So we've been in contact for a little bit here. I mean, you have like a legendary background and career that you've worked through. So it's very exciting to get your perspectives on everything in crypto vol. So maybe before we kind of jump into the crypto side of things, maybe you could just give us like a quick background on how you got into volatility trading in the first place and how did you get started in the markets?
Hi. So I started really in TradFi. I was like a risk quant for a few of these banks. I'm based in Singapore, so I was a risk quant in the banks in Singapore, doing things around model validation across a whole bunch of asset classes, and then had an opportunity to join a equity derivatives trading desk. So I initially joined as a kind of like a desk quant, and then people left and had the opportunity to move up and started trading equity derivatives. But primarily, a lot of my trading was trading baskets of autocallables on a basket of stocks and indices. So I did that for about 8 to 10 years. And on the onset of COVID, I joined. I left the banks and went to crypto and joined a big market maker. And so that's and then did that for 4 years and taking a little break now, trying to complete my PhD and looking back to joining crypto again. So that's pretty much the career. In terms of like education, I have a master's in financial engineering, and then I'm doing my PhD in sort of like finance. And the trading was with it started with equity derivatives, and then we were hedging a pretty big book of autocallables on baskets. I think something like 500 to a yard of notional, and our hedging notionals were even bigger, at about one and a half yards at peak. A little bit of color on that, right? So COVID was I traded through a few events in TradFi. I started after GFC, but traded through China's stock market crash, traded through Armageddon. That was a big one. And it was none of them really compared to COVID. COVID was a very big event, especially for guys that are trading sort of like exotics, autocallables, kind of correlation products, because during COVID, obviously vol spiked a lot, correlations converged to 1. But also, particularly for equities, there was also a very big change in dividends, right? So dividends is one of the sort of like the big parameters for exotics, for equity exotics. And during COVID, basically dividend projections before COVID were sort of like 3 to 5% growth on a yearly basis for a majority of stocks, and during COVID, that basically went to 0.
Interesting.
And the book was Go ahead.
So real quick, just for context, so when you say trading autocallables, like what is the structure of an autocallable? What does that look like? Just so we can have some context.
So basically, autocallables will be people, investors will be kind of getting a series of contingent coupons, fixed coupons, and then they are selling sort of like a exotic put on a basket of underlies. So that's a lot of the structure of these products, right? Where you get sort of a pretty good yield. And it could be something like 30% or 40% annualized. So those are like pretty substantial coupons. and then on the back of that, they'll be kind of like selling a out of money put. And the put could be pretty exotic in terms of features, right? There's like barriers and the barriers could be like roll downs, and there are like knock-in, knockout features, and usually the basket will be like the worst of basket, right? So yeah, I mean the that's the basic structure. It's not that different from as any yield structure. Typically, what you'll be getting is you're getting some kind of enhanced yield. In exchange for that enhanced yield, you're really selling some sort of option.
Yeah.
So that's the basic structure. And to price all these kind of options, the dividend projection is an important pricing parameter. And during COVID, that parameter basically went from like 3 or 5% to 0. And the desk is primarily sort of long dividends. And you know, when it sort of went 0, and that was really just on the valuation basis, it was a big hit to the book. And another sort of more technical reason around why it was really pretty bad for an autocallable desk is the use of a very popular sort of vol model. A lot of banks use some version of a local vol model, and a local vol model has a simply put, it has a kind of like a pretty bad. It underestimates how skewed the vol smile becomes during really stressed times, and it basically underprices hedging costs during these crashes. So so basically you kind of like priced in a very cheap hedging cost. And then it turns out that when the market is really low, spot vol correlations are really high. And when that happens, are really negative. And when it happens, hedging cost becomes really expensive, and whatever you price, 12 months before is basically underpriced. And so a combination of these factors was really a big hit on the book that we were kind of running.
Yeah.
And go ahead.
That makes a lot of sense. So just so I can just restating this just to make sure my understanding is correct. So a couple of the main assumptions COVID completely disrupted. So when we're essentially pricing exotics, there's a lot of variables. So you're replicating sort of a complicated payout structure for a customer. You're replicating that with vanillas, and so there's a lot of built-in assumptions into your vanilla model. And so you're saying when COVID happened, not only does vol jump a lot, but the reasons for the vol jump include the diversification component of the index that you're using kind of goes away. So now the volatility of an index or a basket goes up a lot because the correlation has gone to 1 essentially. So there's a lack of like that tampering effect. And then you're saying the other big component that people might not think about is sort of the dividend yield that's built into the model now goes from plus 3% down to 0. So then that gets squished a lot. And so if you're doing sort of an exotic desk, how come those losses are not necessarily just like if the customer is the one selling essentially some sort of vol or some sort of secure put structure for a coupon, how come that vol sale is not just essentially hurting the customer, but it's hurting you guys in sort of your hedging strategies? Like, yep.
Yeah. So two points of clarification. And number one is that it's a little bit like what you're saying, but really whenever you're kind of pricing like a derivative, particularly a complex derivative, right? The pricing is sort of like the expectation of the hedging cost in replicating that option.
Mm-hmm.
So basically what happens is that because of some characteristics of the models that people were using at a point in time, it basically underestimates the paths where the hedging costs are very, very expensive. And then so there's the amalgamation of like a whole bunch of like, if you will, Monte Carlo paths, right? So yeah, I mean, for most of the median paths, they're fine. They're correctly priced. But for like the tail paths, the paths where stocks crash 30%, vols spike 50%, those kind of paths, the model sort of underestimates the effect of it. So it says that so when you amalgamate all these potential hedging costs together to give a price, basically that price is you're basically selling away something that is underpriced.
Yeah.
So that's where from a pricing angle you was mispriced. And then to answer your second question, right, the desk, if the clients are kind of selling options, they're short vol. So the desk is long vol. So what is really so detrimental about COVID and this vol explosion that has a bad effect on P&L, right? So the answer to the question is that usually trading desks, derivative trading desks, we don't take directions in anything that we can hedge. So anything that we only take directions in things that hedge. In this case, we take directions effectively on dividend projections. We take directions on correlations, things that are not easily hedged, and then we sort of warehouse them, and then we try to take a spread off them. So for everything else that we can hedge, deltas and vol, vega, we sort of hedge in the market, right? So if you will, one way to think about it is that the efficiency, the vega efficiency of exotics is a lot less than that of it's a lot more effective than the vanillas, right? So roughly put, if you have $100 worth of exotic vega risk, you in terms of notional, right? Mm-hmm. You sort of need to be hedging. If you want to completely hedge away vegas via the vanilla market, you sort of need to go like $150 of notional, or depending on the regions you are, you might be even hedging $200 worth of notional in terms of vanilla. So what you have here is that most of the time you're kind of like always neutral. So you have $100 worth of exotic vega, you have $200 worth of vanilla vega. Right, you're long the exotic vega, but you're short the vanilla vega in 1 to 1.5 or 1 to 2 kind of notional, right? So imagine when the market really comes off. What will happen is that your vanilla side that you're short, and typically you'll be shorting a lot of tails, right? And when times were good, when times was fine, you're kind of like selling tail options on an Amazon, on a Microsoft, etc. And then when sort of like shit hits the fan, all these tail options that you sold, they actually very quickly become at the money options, and you're sold like 2 times of that, right? So that's when you suddenly went from like long exotic vol into basically short everything vol, right? You're now short vol on the vanilla side, you're not that long vol on the exotic side, and then just net you're just short vol, and you're short vol into one of the biggest kind of vol spikes in history. So that's primarily how a lot of these like debts will suffer. Yeah.
Wow, that's interesting. So like, because a lot of the assumptions break down, back to Monte Carlo terms, if I have like a stochastic model for a lot of the variables, basically meaning sort of like a random model for a lot of variables, the dividends part, the implicit correlation part, the vol of vol part, and I run this 10,000 times, now we're at this scenario where it's like 1 out of 10,000, and you're saying that 1 out of 10,000 scenario essentially means you're underhedged at exactly the worst time to be underhedged, and therefore you're short vol when vol is the highest, and you're out of the money short put is now an at the money short put, and so that becomes sort of the sources of losses. And is there nothing that could be done from running an exotic desk? Like, can you guys just carry like I don't know, some 100 strike VIX calls just in case for these types of scenarios, or does carrying that hedge by definition ruin the P&L of normal times for an exotic vol desk? Is just nothing that can be done. It's just part of the business.
I mean, the business was particularly kind of running into bull markets, right? The business is pretty competitive in that a lot of times you kind of, for you to get flow, you need to match best of pricing on the street, and it could be that the best of pricing is sort of priced using some more sophisticated kind of models that give much more competitive pricing and have a much better way of hedging this tail risk, right? So a lot of times it's not so much that you're not only pricing according to your ability to hedge the risk, you're also pricing to sort of match the best market price.
Yeah,
it's a pretty kind of competitive market in that sense. And also, all these kind of like VIX tail protection structures, right? The tricky thing about being sort of long vol, if you're just long sort of mundane vanilla vol, I think it's still sort of fine. But you try to buy these really spiky tail stuff, you not only have to get the direction right, you need to get the timing right.
Right.
So I think this carry trade unwind thing that happened on the second to the 2nd of August is a very, very good example of like, you see news reports of people saying that VIX is at 65, right?
Right.
I mean, the way nobody could access VIX at 65, right? If you were trading VIX futures was peak at 37,
right.
35, something like that. So, and it was only for a pretty short, a moment in time. And it was and if you're looking at, spot or VIX being 65, and then now you have the futures that's trading 37, it's not that easy for you to go short at the 37 as well, right? So trying to kind of like protect yourself by trying to short tails, I think it's a very, very difficult endeavor. I don't think people have really successfully systematically be able to capture that. So being long vol, particularly on the tails, is not just a matter of getting the direction and view right. It is also getting the execution and timing right. And that's very, very difficult.
Interesting.
So yeah, I mean, in a way, you're sort of right that if we try to do these protections, it's gonna kind of be very detrimental on your hedging profits, and it was never very, very thick in the first place. Adding all these tail protections, it's gonna make it like a zero sum or a negative sum game. So
very fascinating. Okay, that makes a lot of sense. So now COVID happens. So then what happens? What do you do next?
So COVID happens, and I was sort of like, the book was more like we're trying to wind down the risk, and you kind of need to wind down the risk at the worst possible time, and that was a difficult, it was a difficult time for the desk, and at the point in time, BTC was actually at $3,000. So yeah, I was always kind of interested in it, and then crypto called and decided to just take a leap of faith and try crypto. So I joined crypto when it was like on onset of pretty much like 1 month into COVID, when BTC was kind of plunging, and that's actually my introduction to crypto.
Yeah, that's fascinating. So when COVID happens, Bitcoin's at 3,000, and you jump into crypto. Had you been already following crypto markets, and then had you been following crypto vol markets as well at that point, or was it like completely new?
No, it was like complete leap of faith. I mean, I knew a little bit about crypto, but at that point in time, it was like as if it was tech, and it was all about how proof of work works and all this kind of stuff. I think for people that are in crypto for a lot longer, I think the tech can be pretty separate from the markets, right? So what I'm really, what I do know and what I'm interested in is the markets. And I think that's kind of different from what the underlying blockchain tech is.
Yeah.
It took a while for me to understand it.
That makes a lot of sense. So you mentioned, okay, in the equity space, for example, like the Ford's assumption was shifted a lot because dividend assumptions went from +3 to 0. While in crypto, we have insane forwards, and when you jumped into crypto, for example, long-dated futures, when Bitcoin was at 3,000, were negatively priced. Does that even matter in your modeling? And if so, like, what are some of the differences that you noticed right away when starting to look at crypto and crypto vol versus sort of the equity space?
I think in crypto, probably the most sort of novel invention is this idea of perpetuals. I think that's the defining thing where you don't see anything. It's probably the biggest market that we have in crypto, and yet it's the one that it has no equivalence in the world of TradFi, and because of this, I mean, its existence brings along with a lot of sort of peculiarities of crypto, right? Like because of perps and that you have a funding rate that keeps spot and perp prices in check, etc. The idea of carry arbitrage and stuff like that, it doesn't fully work, right? There are definitely people that are doing like CME dated futures against spot, and that's a very typical commodity carry, right? But it's much harder to kind of like say to assume that same relationship for perpetuals. So again, I think perpetuals is really the biggest difference in terms of like derivatives, in terms of pricing, in terms of portfolio constructions, etc. And yeah, I mean, if you really kind of like think about like how I've kind of worked in the market maker for a while and sort of understand much better how I used to think of market making as like this black box thing where everything is just done by like PhDs with advanced degrees in mathematics and so like a complete black box. But as I started to work more in this, I actually think there's quite a lot of sense to it, right? And another kind of peculiar thing about perpetuals is that market making for perpetuals, it does not exactly have much to do with non-arbitrage principles, right? In that typically for a perpetual, the sort of straight way to think about it is that if I just arbitrage between the spot and perpetual market, and then that will sort of keep the relationship in line. But you see that in crypto, perpetual market liquidity is a lot more than the spot liquidity, right? Which means to say that that already tells you that there mustn't be a very tight relationship between the spot market and the perpetuals market, and if you look a little bit more underneath the hood, right, you sort of start to appreciate that the perpetual market is sort of its own market, right? In that even if you don't have spot inventory, right? So a typical arbitrage relationship would be that, okay, I'm offering a perp, and then I got taken on. Let's say I'm bidding a perp, and then somebody hits my bid, right? So now I'm long a perp. So the natural thing for me is that I'm trying to go to short a spot, right? And I sort of need to have inventory for me to short spot. And then this is the kind of like arbitrage relationship, right? But actually now you see, markets like Hyperliquid, you see, Avo and a lot of these sectors, they actually have pre-launch perps that are trading, right? And then that obviously means, and that mustn't have any spot because tokens are not live yet, right? So why is it that they can sort of still provide liquidity on these markets? And I kind of, in my head, I think of it as it's because the way that the perp market liquidity actually works now, it's like it is a liquidity begets liquidity kind of situation, right? In that the reason why I'm willing to be providing bid offers on the perp market is because I'm sort of confident that I can get out in the perp market. Meaning to say so simply put, I'm in the perp market providing liquidity because I know that there is another person providing liquidity on the perp market. And that person is also providing because he knows that I'm there. So it's sort of like a liquidity begets liquidity, and this liquidity just simply bootstrap without too much of a kind of like arbitrage relationship with the spot market. And that will perfectly explain why the perp market is actually a lot bigger than the spot market, right? And then the funding rate is a derivative of the market that tries to keep it in line. So that to me is like the real sort of like the real different thing about derivatives in crypto that I think is really quite different from TradFi.
Yeah, that's fascinating. I never thought about the notion that the derivatives market is so big and so liquid that it can actually trade on its own relationship, and there doesn't necessarily need to be a spot market, like you said, in the pre-token launch perps. For those who don't know, this is like a speculated protocol is going to do an airdrop, and companies like Avo will launch a tradable perp before the token is even launched, and so what you're saying is because people are willing, because there's liquidity there, people are willing to market make that pre-token launch even without having the ability to hedge in an underlying market. And so you're saying that difference is really large because essentially the funding rate that's derived from the perps market affects the vol surface. Is there a relationship between a consistent relationship, in your opinion, between the perps market and the futures market? Is the 30-day future really a good proxy for the stream of funding that the perp would issue over the next 30 days, or does that trade pretty independently as well?
I don't think they trade independently. I think they trade sort of in a correlated fashion. But given that if you look at like the funding, the formula for like funding, perpetual funding rates, right? They have these like clams, and it's a function of price differential between spot and the perp price. I think it sort of trends in the right direction, but there is no mechanical way for you to really kind of tie them, or i.e. arbitrage between them. And it's because of all these artificial sort of constraints that put on, right? It is also pretty hard for you to see a fixed float market, right? So like in traditional finance, whenever you have like a case of like floating rates and you have a case of like fixed rates, the mechanism that ties them together will be all these like RRSs or CCSs that ties them in. Everything is sort of pretty tight and non-arbitrageable, right? There are, but still generally non-arbitrage sort of works. But you don't really see them in crypto as well, right? Not as of now. And I think that's another very big reason, is because there are all these artificial sort of non-free market constraints. The clams are a good example of them, and these funding rates are sort of, can be arbitrarily moved by the trading location. So because of all these constraints, I think this is one good reason why you don't really see the rise of like a fixed float market for rates in crypto as of now. So
yeah, I see what you're saying.
And given that the crypto exchanges there is also another element, right? Because the crypto exchanges, a lot of them, at least the biggest ones, are not really regulated, right? And then they have embedded rates, etc., which then again makes it very difficult for you to do this pricing, to price out this thing, where you not only embed the volatility of rate, you also have to embed the credit associated with the location that you're trying to do it, and then there were many more risk factors for crypto that makes this pricing and replication problem a really complicated one.
Yeah, that's fascinating. So in traditional finance, interest rate swaps will tie a strong relationship between fixed and floating. Crypto doesn't have sort of that same tight relationship. So even though they're correlated, the relationship's a lot more noisy. And now you're saying when you're modeling sort of essentially all the variables for an exotic desk, you have to include sort of the noisiness and also include things such as like counterparty risk from where you're trading on which venue and stuff like that. From your perspective, are the sort of exotic products that customers were looking for in crypto similar to the products that customers were looking for in equities, or is the demand side also very different?
So in my head, they're like two sort of dynamic, right? I think that the one of my I read a tweet from the founder of Paradigm, right? That I think what he says is really smart and correct. That because of the existence of perps and the leverage that it can extend and the liquidity that it provides, there is less of a reason for people to kind of go towards options, because options can be a little bit more esoteric and not well understood by people. But perps are Delta One product, and you get the leverage and the volatility anyway. So that because of that existence, the options market didn't sort of. Everybody talks about the fact that options market in crypto is 10x smaller the Delta One market, whereas it's sort of the reverse in TradFi. But again, TradFi does not have the perps product, but crypto we have, and I think that's a very big reason why this same dynamic of options volume being multiples of spot of Delta One volume, it doesn't really manifest in crypto. I think perps is a good reason for it. And to answer your question, right? I think exotics in crypto is not really a thing, not as of now, right? So there are a few reasons for it. Number one is, if you think about why TradFi has exotics, it's because the yield provided from the vanilla, it's not attractive enough, right? And so, like I was telling you, a typical structure of an exotic would be you selling some sort of put, i.e., albeit an exotic put, nevertheless selling a put, and then getting a yield via the premium that you're selling, right? So the only reason why exotic exists is because it has a higher chance of being struck in, getting having a worse outcome for the client. You get more yield for that, and that's more attractive than vanilla. So in crypto, because of the volatility, it's decent. The yield itself from vanilla options is already decent. So again, that would be one reason why, like, if you have something that's kind of good enough, you don't really need to kind of build or invent on top of it to get more yield. Whereas in TradFi, for a stock like I don't know, Amazon or just S&P index, the vol is pretty low, right? VIX before explosion was at 12. So whereas the vol is at 55. Right. So the yields that you get on it's already much more substantial. So the need for you to go up the complexity ladder in search of yield is less. Another thing is that a lot of these demand for yield products, they derive from like the wealth sector. What I mean is, like, think of private banking, private wealth in a bank, right? And I think the defining characteristic of that business is the fact that the bank is able to sort of like custodize your assets, your wealth. They recognize, that you put in money into this wealth, this private banking setup, and then they sell you yield products on these assets. And then in the event of a conversion, basically your cash becomes stocks. But nevertheless, they're still recognized assets. They can kind of custodize. You continue to maintain the relationship as like a private wealth banking client. Now, we don't have that set up in crypto, right? I mean, sort of like the rich, they don't. It's not common for them to kind of put their wealth on chain, right. Like in cold wallets or in custody. Right. It's not a thing, right? So without the ability to sort of custodize assets, it is very hard to kind of grow the kind of structured products or you business because you cannot have delivery. A lot of things have to be like cash settled, and that's not a thing, right? When this private bank sector, when it buy, you're selling out of money puts on stocks. The primary kind of assumption is that, well, if it goes down, I'll collect Amazons, I'll collect Nvidia at much lower prices than now. I'll just keep it in custody with the bank, and it's part of my wealth. Whereas because of the inability to do this in crypto, again, there is no natural way for you to have the same mentality of like, okay, if I just set out money puts on BTC and ETH, I get converted, I'm going to kind of stay in BTC and ETH, but you can't, because you cannot deliver the BTC and ETH. No, financial institutions as a whole do not store them, not yet.
Yeah, right.
And then you kind of need to cash settle, and then if you're cash settling, then you don't have this concept of kind of hodling, and so the whole thing doesn't really work. So I think these are like kind of like industry reasons why you don't really see not a big amount in crypto. Vanilla option good enough for you. Don't really have kind of private wealth kind of money and flow that would support a substantial size of the exotics. There are some, I think, Sega. There are few protocols out there doing some of it, but it's still very, very, very small compared to options volume, which is very, very small compared to perps volume. I think that's kind of where we are in the industry right now.
Yeah, that's a very fascinating insight. The idea that if I'm getting exercised in traditional finance on my exotics, I'm essentially just assuming the underlying. So the loss is still like psychologically kind of a paper loss because I'll just hold the underlying till it rallies again. But if I get a cash settled loss, just because of custody reasons, it's almost a different type of loss. That's very interesting. That makes me think about the spot Bitcoin ETF and now the spot ETH ETF. Hopefully, we get options on those pretty soon. How do you think that changes the crypto vol market? Because now I would imagine that wealth clients can just take the underlying in the spot Bitcoin ETF and just hold that now, and we have sort of a different pipeline of customers in traditional finance who now have access to clean crypto vol products in the spot ETF. Does that affect anything, you think?
It will, I think. I think the ETFs is the way. I think generally speaking, crypto is people say that crypto is kind of like a retail product, right? I think more accurately, I think crypto is the price action of crypto is very related to like flows, right? So in the last cycle, before FTX happened, I think the fiat rails into crypto, it's a lot, right? Most of the bigger exchanges, particularly the US ones or the Europe ones, they allow sort of like retail or exchange users to just bring fiat on chain and into crypto. Mm-hmm. I think after FTX happened, basically almost probably except for Coinbase, everything else got shut off. And I think it is that shut off of fiat liquidity that is a primary driver for why we crashed after FTX. So this in this cycle, we do see some reopenings of this kind of fiat rails, but definitely not to the magnitude that we see in the last cycle. Last cycle there was Celsius, and there was a lot more of these setups you're able to bring substantial fiat liquidity into the system, and you can bring retail fiat liquidity into the system. Right now, they sort of did it another way now in this cycle. They say, well, we have the ETF. And then retail can buy the ETF. The money sort of comes through the pipe of the ETF, right? The market makers and the entities that are dealing with providing primary liquidity for ETF sort of creation and redemptions. Mm-hmm. So that's where and that's also I think why we saw this sort of a new cycle begin. And it's this influx of liquidity that entered into crypto that really prompted the revival of the cycle. So for sure, I think the BTC ETF and now ETH, it is the one very sort of valid way that liquidity returns back to crypto. And in terms of like the vol complex, I think the options on ETF is probably gonna get approved probably late 2024 or early 2025, and there will be some there will be some sort of rationalization with Derivs. I mean there was sort of already, right? There were people doing trading between Derivs options, and then there was this futures basically it's Beetle, right? So Beetle had options, and there were people sort of trading between these two markets. So it's already something that was done. I think the ETF, the spot ETFs will be an even more straightforward kind of one-to-one match with Derivs options. So I think there will be some rationalizations between these two markets. That said, I don't think it's going to happen like overnight, right? There are a lot of like embedded premiums that we were talking about, right? Like Derivs compared to CME is different scale in terms of how TradFi thinks of them, in terms of credit, in terms of regulatory standards, etc. So I think these premiums will still exist, and it will take time for them to. I'm not even sure if they will completely rationalize. There definitely could be some world where there are like almost like an onshore offshore trading venue for derivative crypto options. One that's onshore, i.e. like a Binance, like a Derivs, that's like more crypto native, and then there will be one that is on the retail market on CME or CBOE or something like that, or that will be more for like TradFi and people that not native to crypto. I think that could exist.
Yeah, that's fascinating. So there would be almost like two different vol surfaces that are similar but slightly different. Do you think that Deribit continues to be the main venue in the offshore world?
I mean, Deribit has proven to be very resilient, right? There are I mean, if you kind of look at like hedging delta hedging locations, Deribit wouldn't really strike you as like the main one, right? That it's the main options location. I think the coin margin futures have decent liquidity, but the main liquidity for delta hedging still kind of resides outside Deribit, and I think for a long time, many industry observers, me including, was thinking that it's just so obvious that another exchange is gonna try to provide, it's going to do options, and then the hedging was already there anyway, so the market share will just get taken away. And I think Deribit has kind of shown that it's pretty resilient, and none of the big competitors trying to do this have really succeeded in wrestling market share away. Mm-hmm. So I think this first mover advantage is like a really important thing in crypto. So I think we shouldn't. Binance is another super good example of like, Binance is too much bigger in terms of trading volume, say, compared to Coinbase. So I think we shouldn't really kind of underestimate this first mover advantage and the crypto native advantage that venues have.
Yeah, that makes a lot of sense, and like such a good point. For example, like Binance being such a big Delta One venue, it's basically the biggest Delta One venue in terms of perps trading, but their options market is very small, whereas Deribit has a smaller perps venue or Delta One market, but they essentially own the options market. It's very interesting that essentially the volume for the two related products kind of live on different exchanges. But yeah, like you said, the first mover advantage is very strong. And I mean, Deribit's just a great company. I obviously love Deribit. But I think the block trading on Paradigm, you mentioned Anand earlier in Paradigm, I think is also a very a strong barrier to entry for Deribit. Essentially, all the block trading, which is about 30% of the volume, gets settled on Deribit. I think that's hard to dislodge that as well. It's very interesting. Neo,
yeah, and also just on the last point on that is, I might be wrong here, but I think the sort of like the setup to run these types of exchanges is also quite different. I think there is probably a very, very good commercial reason in terms of like the actual product offering that a place, say for Binance, wouldn't really want to, if you will, almost corrupt or dilute that what they're offering, right? If a lot of what Binance is offering is just super liquid, Delta One, straightforward products, and everything in the organization is kind of geared towards offering the best product for that audience. Maybe kind of like offering options and a whole bunch of other stuff on top of that. It muddies the offering, and I think that's surely. I've talked to kind of a few people before, and I think that's part of the consideration. So similarly on Deribit side, right, where if they have kind of factor in the other considerations that you need to have a very big and viable like Delta One perps business, I think that will again create constraints on what they do really, really well as an options business.
That's so
I think that will be probably another like very good reason why they kind of stay in their own sphere and not really try to complicate stuff.
Yeah, that's such a good point, especially because the natural audience of like a major pair options business is very different than the audience of like tail altcoin perps business. Like the trader base is different.
Yeah. Yeah.
So Neo, usually I like to finish these interviews with some more personal questions. So one that comes to mind is, if you wanted to give some sort of advice to anyone who wanted a career like yours, what would some points of advice be?
Um, I think I don't actually think crypto is really that different from equities. I mean, if people like equities and you try to kind of trade equities, you kind of got to read and got to find out a lot of what every individual company does, and then there's this macro narratives that sits on top of these micro stories, and crypto is a lot like that. I mean, you can go deep diving into projects and coins, but there are underlying sort of macro narratives that will make you want to buy or sell Bitcoin, for example, right? So I think they're quite similar. They're also very similar in terms of in vol terms, right? Crypto vol when I joined it was 90 easy. Now it's 50, and 50 is high, and people sell it down to 35 at times, right?
Mm-hmm.
I think the natural evolution of any established asset is going to be in IV is going to kind of drop. So in terms of vol dynamic, it's also not that different. It's quite similar to a Tesla or Nvidia. They're like at the same region of vol. So vol wise, in terms of like how you understand the sector is very similar. So if you like equities, you're equities guy. I don't really think crypto is really that different. It's a nice crypto is like a nice. There's a lot of crazy stuff, and I think that's kind of why it's fascinating. But I think having a decent curiosity about trying to learn about different things is a nice amalgamation of like tech, finance, markets, and VC, and a bit of everything. So I think if you have like I'm naturally quite curious a person, and this crypto naturally draws me to it. It's so interesting is like there's some absurd stuff in it, and there's like some really smart stuff in it. So I like that. And my advice is that particularly now I have more time to kind of do stuff and read and watch the markets. I think writing is a very useful thing to do when you're trying to understand markets and trying to be a better trader, be a better analyst. I think just write more. The more you're able to write, articulate what you want to say, explain to people, I think the better you understand it, and it kind of gets ingrained in yourself for what to do when market events happen. I recommend that a lot. I think I'm a better trader when I write more. For like things outside work, I have a young family, so I spend a lot of time with family. And yeah, as you mentioned, I have a Telegram channel, and I think we posted in some show notes or something. But yeah, feel free to kind of join. And I write about a whole bunch of stuff, macro, vol, some memes, and so yeah, you can join and join the channel.
Yeah, absolutely. We'll put this in the description below so you guys can join the channel. And then lastly, do you have any favorite books that you would recommend?
I think there's an interesting one, Scale. It talks about it's a book that kind of points out that there seems to be some similarity in terms of there's some similarity in scales across like a whole bunch of different stuff, like the number of breaths that a elephant and a mouse takes is the same, but the mouse takes a lot more breaths per second than an elephant, and an elephant lives longer and things like that. So it's one interesting book, Scale, Geoffrey West. And there's another really good Substack that I read if you guys are into options. There's one that's called the Moon Tower. So that's a really good one. It's written by obviously a very very good derivatives kind of quant, but also from a trader's perspective. And I think that's kind of the way that I try to understand options. And I think it's one thing to quote Black-Scholes and all the formulas and stuff like that, but it's a complete other thing to be able to appreciate what it really means and apply it intuitively and quickly trade. So yeah, I highly recommend a read for that.
Oh, fantastic. Well, Neo, thank you so much for coming on. This is very interesting. I mean, a lot of insightful stuff. I learned a lot. I'm sure our listeners learned a lot. Really appreciate your time.
All right, yeah, thanks for having me.
Absolutely. And to everyone else, we'll catch you next time. Thank you.
All right, thank you.